Right now, as you're watching this, someone just created $100,000 out of thin air. They didn't print it, they didn't mine it, they typed some numbers into a computer, and now that money exists. And before you think this is some elaborate scam or conspiracy theory, I need you to understand something. This is exactly how the system is designed to work. The money in your bank account, the money you work for, the money you save, most of it was never actually created by a government. It was created by regular banks using a mechanism so simple it sounds like a magic trick. And once you see how it works, you can't unsee it. Let's start with a question. Where does money come from? Most people would say the government, right? The Federal Reserve or the Treasury or some official building with important people making important decisions about how much money should exist. And that's partially true, but here's the uncomfortable part. Only about 3% of all money is actually created that way. The rest, the overwhelming majority, is created by commercial banks every single time someone takes out a loan. Not printed, not minted, just created digitally with a few keystrokes. This isn't a fringe theory. It's not even controversial among economists anymore. The Bank of England published a paper in 2014 explaining this exact process, and it contradicted what most economics textbooks were teaching. So if you feel confused right now, good. That means you're paying attention. Here's how it actually works, and I'm going to explain it so simply it'll sound absurd. Let's say you walk into a bank and ask for $10,000 loan. The bank checks your credit, decides you're good for it, and approves the loan. Now here's the part that breaks most people's brains. The bank doesn't go into some vault, pull out $10,000 that other people deposited, and hand it to you. They don't move money from one account to another. They simply open up their computer system and type $10,000 into your account. That's it. That money didn't exist 10 seconds ago. Now it does. You're thinking, wait, they can just do that? Yes. They can just do that. But there's a catch, and the catch is what keeps the whole thing from imploding immediately. Banks are required to hold a certain percentage of their total loans as reserves. This is called the reserve requirement. For a long time in the US, that number was around 10%, meaning for every $100 a bank created through loans, they only needed to actually have $10 in reserves. But here's where it gets even stranger. In March 2020, the Federal Reserve dropped the reserve requirement to zero. Let me say that again, zero, meaning technically there's no hard limit on how much money banks can create as long as they can find people willing to borrow it. Now, you might be thinking, okay, but when I pay back the loan, that money goes back to the bank, right? Not exactly. When you pay back a loan, that money disappears. It gets deleted from existence. You created it when you borrowed it, and you destroyed it when you repaid it. The only thing the bank keeps is the interest. That's their profit. The principal just vanishes back into the void. So let's follow the logic here. Banks create money when they issue loans. Borrowers destroy money when they repay loans, but they also have to pay interest. And here's the part that should make you pause. If all money is created through loans, but you have to pay back more than you borrowed, where does the extra money come from to pay the interest? The answer is it has to come from someone else taking out another loan. This is why the system requires constant growth. It's not optional. If lending stops, if people stop borrowing, the whole thing starts to seize up. There's always more debt in the system than there is money to pay it back, which means someone, somewhere, has to keep borrowing new money into existence just to keep the wheels turning. It's like a game of musical chairs, except the music never stops because if it does, everyone realizes there aren't enough chairs. And this brings us to something most people don't connect: inflation. Everyone blames the government for printing money. And yes, the Federal Reserve does create base money, but the vast majority of inflation doesn't come from government printing. It comes from banks creating too much loan money too quickly. When banks flood the system with cheap credit, prices go up. Housing bubbles, stock market bubbles, asset bubbles in general, they're all downstream of banks creating money faster than the real economy can absorb it. Here's the illusion. You think money is scarce. You think it's this finite resource that has to be carefully managed and distributed. You go to work, trade your time for it, save it, budget it, stress about it, and all the while banks are generating it out of nothing every time someone signs a loan document. Here's the reality. Money is abundant, absurdly abundant. We've created more of it in the last 15 years than in the entire previous century, but the system is designed so that it flows to specific places first. When a bank creates money through a loan, who gets that money? The borrower. And who can afford to borrow the most? People who already have assets to use as collateral, people who already have wealth. So the system naturally concentrates money at the top, not because of some conspiracy, but because of the basic mechanics of how money enters the system. This is why central banks can inject liquidity during a crisis. They're not redistributing existing money. They're creating new money and handing it to banks, who then either hoard it as reserves or lend it out to people who are already creditworthy. Meanwhile, people at the bottom of the economy are told there's not enough money for basic services, not enough for infrastructure, not enough for healthcare. It's not that the money doesn't exist, it's that the money creation mechanism doesn't flow in that direction. Now, zoom out. If this is how money works, what does that mean for everything else? It means the economy isn't really based on productivity or innovation or hard work, at least not primarily. It's based on credit, on the willingness of banks to create new money and the willingness of people to go into debt. When credit expands, the economy grows. When credit contracts, you get recessions. It's almost mechanical. And here's the uncomfortable question nobody wants to ask. What happens when everyone is already maxed out on debt, when households can't borrow more, when corporations can't borrow more, when governments are already running massive deficits? You can lower interest rates to make borrowing cheaper, and central banks did that for years, pushing rates down to zero, then below zero in some countries. But eventually, you hit a wall. People don't want more debt. They can't service the debt they already have. This is why every major financial crisis in the last century has been preceded by an explosion in private debt. 1929, 1987, 2000, 2008. Every time banks created too much money, loaned it into existence too fast, and when people couldn't pay it back, the whole system seized. And every time the solution was the same: create even more money, bail out the banks, and restart the cycle. So where does that leave us? You now know that most money isn't created by governments. It's created by banks out of nothing. Every time someone borrows, you know that this system requires perpetual growth, perpetual borrowing, or it collapses. You know that the money you work for, save, and stress about is mostly just digital entries in a database, backed by nothing but collective belief and legal enforcement. And here's the question I'll leave you with. If money is this easy to create, if banks and central banks can generate trillions of dollars with a few keystrokes, why do we pretend it's scarce? Why do we organize society around the assumption that there's not enough when the limiting factor isn't the money itself, but the political decisions about who gets access to the money creation machine? The system works exactly as designed. The question is, who designed it and who is it designed for? Because once you understand how money is really created, you start to see everything differently. The debates about taxes, about government spending, about whether we can afford things, they all start to look like theater. The money isn't the problem. It never was. The problem is how we've chosen to create it, and more importantly, who we've chosen to give it to first.